It's October 1987 and the stock market is tanking fast. Investors scramble, panic spreads like wildfire. But economist Andrew Lo isn't just watching chaos. He's asking why markets go haywire despite the theory that they should be perfectly efficient. What if markets aren't just rational machines? What if there's a hidden evolutionary dance going on, shaping every crash, every rally? Welcome to the world where money meets biology and markets adapt faster than you think. Forget dry graphs, markets breathe, evolve, and sometimes freak out like living creatures. Lo takes us into this wild ecosystem of traders and money mixing biology with finance. In 1987, Black Monday shocked the world. The Dow dropped 22% in a single day. Investors didn't just lose money, they lost control. Lo points out how panic buying and selling mirrored ancient survival instincts, fight or flight, triggered even in high-tech trading floors. Lo argues markets are like ecosystems, where humans' evolutionary wiring still drives behavior. Imagine a forest where animals respond instantly to threats, that snap judgment might not be perfect but can save a life. Similarly, traders react with intuitive impulses, creating bubbles or crashes as markets adapt to new information. Once you see markets as living systems, you spot opportunities. Just like predators exploit weakness in a herd, savvy investors can capitalize on market inefficiencies that only pop up because of human instincts firing. That's the twist. What looks irrational can actually be a new kind of rational in the market's survival game. You think markets are either fully rational math machines or crazy gamblers. Lo flips that view, showing how reason and madness live side by side and what that means for your money. Lo tells the story of neural circuits lighting up in investors' brains, the same place fear and reward mingle. When markets are calm, rational thought dominates. But during turmoil, emotions hijack decisions. It's like your brain runs dual programs, sometimes investor, sometimes gambler. He explains this with a vivid analogy. Think of your brain as a sports car with two drivers. One's the smart analyst navigating the road, the other's the wild racer craving speed and risk. Market moves arise from the messy handoff between these drivers, sometimes seamless, sometimes disastrous. Lo's adaptive markets hypothesis offers a spectacular turning point in economics. It's a hybrid theory. Markets can be efficient or inefficient depending on context. This uncertainty means regulations and strategies must flex, not rely on rigid models, embracing human quirks rather than denying them. If markets evolve like species, then survival depends on adaptation. Lo shows how understanding this unlocks smarter investing and smarter regulation. Lo dives into the rise of financial derivatives, complex tools that change the market's DNA. Like mutations in nature, these innovations introduced fresh risks and rewards. Some investors thrived by adapting quickly, others got caught out by new dynamics they ignored. Markets cycle between calm and chaos because of this continual change. It's like wildfire spreading, then regulation acting as a controlled burn. Instability isn't a bug, it's a feature. Investors who understand this can anticipate shifts, positioning themselves ahead of the herd. The payoff? Investors who use adaptive strategies, learning from past cycles, testing new approaches, tuning to market conditions, outperform those stuck in static textbook models. It's a real game changer. Evolve or get wiped out in financial ecosystems that never stand still. Remember that frantic day in '87? What seemed like senseless panic was actually investors' ancient instincts firing off in real time, a raw evolutionary pulse beneath the flashing tickers. Andrew Lo teaches us that markets aren't broken machines but adaptive creatures. So next time you invest, try this. Instead of seeking perfect predictability, pay attention to how markets evolve and adapt your approach like a survivor in the wild. Subscribe for more book summaries like this one.